You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, coming to you live to tape from the Options Industry Conference here in scenic and sunny Austin, Texas. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. And we're kicking off our interview coverage here at the OIC Conference 2014 with our first guest. He is an old friend of the show, even though he hasn't been on in a while, but some listeners may remember him from his recent appearance on the relaunch episode of Volatility Views. He is Pat Fay, the head of derivatives for the index group over there at Russell Investments. Pat, welcome back to the program.
Thank you, Mark. It's great to be back.
Now, Pat, I know you've had a long and storied trajectory through the world of options. For those of our listeners who haven't had a chance to catch your other previous appearances on the network, why don't you go ahead and give a quick overview of your background in the business and how you found your way over there to Russell?
Oh, all righty. I have been in the business about 32 years. Started out at the Board of Trade Clearing and Futures as a programmer. Moved over to CBOE in 1984. Had a long and prosperous career there, including heading up the launch of the CBOE Futures Exchange, VIX Futures. I remember the days when it was very slow going and it was tough to get those 100 lots up on the tape, but now VIX is doing fantastic. I left CBOE and took some time off, joined Russell Indexes as the head of their index efforts, and am now promoting Russell Index options, index futures, and developing new products with them.
Now, a lot of our listeners are probably thinking that's an interesting choice to jump over to Russell, because when you think Russell, the first word that jumps out of your mouth is in options. And yet, of course, they have a lot of products that do some decent volume out there in the options space. Now that you've joined them, they've really have a renewed focus on the options space, in particular making some products that are, shall we say, a little bit more retail friendly from an options perspective. Why don't you go ahead and give our listeners an overview of some of the initiatives you're working on over there to make Russell more synonymous with options in the mind of a lot of the retail options traders out there?
Well, as you might know, Russell Index options and index futures are largely used in the institutional space, but we're taking a good look at how we might encourage retail order flow. IWM options, ETF options, have been very popular, up quite a bit over the last year. So taking steps to make those more approachable, and then looking at the index options, and is there a cash-settled index option, say maybe a mini size that retail investors would be interested in. That's one of the things that we're looking at.
And I know you have a lot of background in the volatility space, and Russell obviously looking at that space as well. It's become the hot area for a lot of institutional and retail traders in the option space these days. For whatever reason, the implied volatility of the S&P 500 and other related indexes really lights up the tape from a retail perspective, of course, with the VIX options and the futures and the whole universe of ETPs around that product space there. And now you guys at Russell have jumped into that fray with the RVX product. Of course, that is the implied volatility of the Russell index, which a lot of people probably are interested in. So why don't you go ahead and give our listeners an overview of that product as well, and what some of the thought process was behind launching a dedicated volatility, or really should I say relaunching a dedicated volatility product for the Russell index.
Well, when you look at it, small cap stocks tend to be more volatile than large cap stocks. Secondly, the small cap stocks are a better barometer, if you will, of the domestic economy. Over 80% of revenues of the Russell 2000 index companies are generated domestically, whereas a majority of the revenues generated by large cap, say the Russell 1000, are generated internationally. So domestic factors such as interest rates, state of the economy, and that are reflected more heavily in Russell 2000 stocks, and then hence Russell 2000 volatility. If you look at Russell 2000 volatility, or RVX, it's really popped this year. Volatility increased in January and February, as we all know, but if I compare it to VIX, or large cap volatility, the RVX has averaged a 32% premium over VIX this year. Last year, in 2013, it was about 23%. As we looked at throughout all of 2013, it ranged from maybe a 10% premium to a 40% premium. But on April 28th, just this past Monday, RVX had a 55% premium over VIX. It was 22.4 versus 14.4 in VIX. So for an active trader or a relative value trader, this may provide opportunities.
And obviously, it's still early days. It only launched towards the end of last year, so it's still a very, very new product. I think it took VIX. How many years did it take VIX, Pat? You were there to take VIX to really catch fire with the audience. 3 or 4 years, probably.
It was about 4 years before it really started taking off.
So it's still very early days in the RVX. But I'm curious, is that the feedback you're hearing from the clientele, whether retail or institutional, that they're starting to be attracted to it because of that exact premium that you're talking about, or is it just the fact that they like the Russell Vol because there isn't a lot of volatility choices out there, so it gives them some new options for hedging or laying off risk? Or is it the vol of vol perhaps in that product? There's a lot of reasons people get attracted to a volatility type product like that.
Well, I think you've hit them all, Mark. And from what users have told us, definitely relative value trading. If you looked at about a year ago, over the summer of 2013, the V stocks versus VIX trade was pretty active. There were research reports out on that. And when we took a look at it, if you like V stocks versus VIX, you probably should pay attention to RVX versus VIX, or maybe RVX versus V stocks. The other thing is people like trading volatility. They want an additional volatility tool, and RVX provides them with another volatility tool. I was speaking with an institutional investor at the CBOE's options conference, risk management conference, and he was happy to see another volatility product out there. He said one that isn't just a mimic of VIX, but moves around a little differently and covers some different space.
That's true, because if you look at VIX, it's become this ecosystem, essentially. There's the VIX futures, the options, and then there's the myriad, the legion of ETPs that surround it. And that seems to be the bulk of the choices, particularly for the retail audience when it comes to volatility products. There aren't many other viable alternatives in that space. So to see something on a different index that has some degree of correlation but is still its own beast, I think that's attractive for a lot of people. Now, at the end of the day, is the target audience for this that very active retail guy who's discovered VIX and perhaps wants some new choices, or is it institutional first? Who are you going after first with this product?
I believe the institutional folks are the ones that are going to adopt it first. What we hope to see happen is the same avenue that VIX took. Get the institutional users involved, get them using it, hedge funds, prop firms, using it to do those relative value trading strategies, or to lay off risk in maybe their IWM portfolio, their Russell 2000 portfolio, things like that. As volume and open interest grows, then get an ETP, ETN listed on the product. VXX, obviously, very successful for VIX. We'd love to see an RVX-based ETN. But first you need the liquidity and the base in both the futures and options product to allow that product to become a success. Once the ETNs come in, then the retail audience becomes even more interested. And then the retail audience comes into the RVX options product. So I think that's the avenue that we're going to see it take.
And are you talking to all those various ETP and ETN providers right now to try to pave the way for some RVX ETPs down the road?
Yes, we have. We've talked to a number of them, and started in December, and have kept in touch with them. We're watching the volume. Volume and open interest is having its ups and downs, but as recently as the last couple of days, there were several hundred contract days, and there's about 1,000 contracts in open interest across the options and the futures. So it's growing. We'd like to see it grow faster, but as you mentioned earlier, VIX was a long road to success, and this one hopefully is shorter, but will be it'll take a while.
It is interesting to watch, because obviously we pay attention to it a lot on our Volatility Views program, what is going up out there and what the use case is for it. And traditionally, we've always seen the volatility products be call heavy because that's what a lot of the interest is as a quasi hedge or spec to the upside. So VIX in and of itself is pretty call heavy, about 3-1. Seems like RVX, obviously it's still early days, but is almost a microcosm of that, where it is almost entirely call heavy. There seems to be no interest in the downside in RVX whatsoever. It's calls all day long, which I think is kind of interesting. I'm sure that'll change as the product expands a bit, but it had been interesting to watch, at least in the early days, that it is almost 100% far out of the money sometimes calls out there, which is kind of interesting. That probably speaks to what you were saying before about that heavy premium for RVX versus some of the other volatility products out there.
Yes, that's true. And we did see a little bit of put activity there in January, before the January expiration and shortly after. And then, of course, we had the big drop in the market there in early February. Don't know if that scared off all the folks' interest in the puts, but the put activity sort of dried up, and it is almost exclusively call activity here in April.
Something I've said a lot in our Volatility Views program as well. I don't know what it is about February. February is an odd month from a volatility and a volatility open interest perspective. If you watch what goes up in VIX in that month as well, I like to joke that's when the February crazies come out. People come out and they'll load up on 70 handle calls and VIX and things that are absurd, and yet for whatever reason that paper seems to come in routinely in the February expiration cycle. I don't know what it is. Clearly there was some weird paper going on out in RVX that month as well. We looked into it, actually. We've looked into the research to see if there's something historically that correlates to volatility activity in the broad markets in February. Haven't found anything yet. It's just odd paper, it seems like, but it all seems to congregate in February for whatever reason. So perhaps that's why there was some outlying put activity as well out there in RVX. Well, RVX, obviously, the most recent initiative. You guys have a lot of other things up your sleeve over there at Russell from an options perspective. So what else are you guys working on to add more to the options suite from Russell?
Well, I'm glad you asked. We recently launched quarterly options on the Russell 2000, or the RUTQ. Our friends at NYSE and CBOE listed those the week of April 14th, and they are PM settled options. They have an end of quarter expiration. They expire on the last trading day of each quarter to coincide with the end of quarter accounting practices. Money managers who rebalance or settle portfolios on the last day of each quarter and use options as part of their strategy have really found a use for these types of options. If you look at the other quarterly options out there, their volume averages maybe 10 million contracts a year, maybe 40,000 contracts a day. Based on that, we think that the Russell 2000 could probably generate around 1.5 million contracts a day, or a year rather. So we heard from asset owners and money managers, most recently at both the FIA conference at Boca and the CBOE conference in Fort Myers, that they were looking for end-of-quarter options. Our friends at the exchanges launched them very quickly, and they've done very well. They've traded 1,700 contracts here in just the 2 short weeks they've been launched, and the volume has been increasing. So that's one of the things that we have going. I think it'll add a lot to the marketplace. Another avenue that we're looking at is the Russell 1000 listed options product. We've talked to NYSE and CBOE about listing options contracts on the Russell 1000. Obviously, you need a good, vibrant Russell 1000 futures market, and we're starting to see increased volume in our Russell 1000 futures over on ICE. What folks are looking at, you might ask, is why doesn't the S&P 500 or the SPX options just suffice? And historically, many users in the large cap space might be benchmarked. Many users who are benchmarked, say, to the Russell 1000 would use other products such as the S&P options and futures. But lately, if you look at the last year, 2 years, the tracking area between the two indexes has diverged, and now it's more of a concern with institutional users, money managers. They want to have a more finely tuned option and futures tool. So we're looking at listing Russell 1000 options on NYSE and CBOE, likely going to happen sometime over the summer. And from there, again, look at the mini options for the retail space. That's on the plate as well.
Let's go back to the quarterlies for a second, because that's an interesting product. We do a lot, obviously, in the advisor space. We have advisor-oriented programming, a lot of advisor content on the website. And a quarterly product like that really seems to speak to that advisor mindset for whatever reason. No matter how many programs we do trying to educate advisors about how they probably want to migrate their premium selling to the near end of the curve to harvest and collect all that theta, they have no interest in that. They're used to doing on a regular cycle with these regular structured products. And a lot of these guys are very busy too. They have a lot of accounts or a lot of clients or a lot of assets to manage. They don't like to roll calls every week or whatever the case may be. So a product like that, structured to come in at a certain frequency that fits right in with the rest of what they're rebalancing in their portfolio, it seems to make a lot of sense, even if it isn't ideal from the options perspective. I'm sure that's the feedback you were getting from the audience as well.
Oh, definitely. The end of quarter PM settlement was very attracted to them. It aligns the single stock ETF options with many look-alike options that trade OTC. Quarterlies are preferred by those investment managers with end of day, end of quarter reporting needs. Plus, the PM settlement kind of ensures that there's no overnight market exposure going into settlement. Cash settlement, European-style exercise, also very important. You don't get portfolio disruption due to exercises, things that go on with dividends. Plus, the large contract size. One might say, well, why don't you just use IWM options and take care of that at the end of the quarter? But the large contract size, $100 multiplier, 10 times the IWM plus all the other features of an index option are more attractive to those institutional money managers. And you're right, they have kind of their set ways that they like to do things, and this addresses those set ways and those needs.
You mentioned the minis coming down the pike as well. Are those going to be minis for pretty much everything we talked about here? So RVX and maybe mini quarterlies, or is that just for certain products right now? Or
I think we would start out with the Russell 2000.
Okay,
that's kind of our bread and butter. Small cap. That's what Russell is known for in the derivative space. So we'd start out there. Test the demand for it, and if there is demand, then migrate that out to our other products.
Speaking of minis and these short duration, bite-size type contracts, this has been a top of mind for a lot of our listeners lately. I'd be curious to get your opinion on it as well. We just had Apple earnings recently, and a lot of people were talking about the volume or perhaps lack thereof in the mini Apple products. Of course, a few years ago, they launched the mini options on mini Apple, mini Gold, mini Amazon, kind of a way to facilitate liquidity from these smaller retail players who don't have round lots of these stocks. They don't have 100 shares of Apple because it's too expensive, but they can write a covered call on 30. That was at least the idea behind them. Of course, the implementation hasn't been perhaps up to that spec where people can actually do a lot of them. The fees are high, the markets are wide, et cetera, et cetera. So I'd be curious, as someone who's been around the business for quite a while, have you been watching the flow on those products, and have you been interested to see what goes on out there? They've been out for about a little over a year now, and yet they still haven't seemed to really catch fire with that retail population yet.
Well, I think you hit on a couple of things there, Mark, that are relevant, and that is the fees. I mean, a retail user is fee sensitive. That's a given. And when fees, for instance, are the same, if you will, as a regular options contract, yet it's 1/10 the size, that does take a chunk out of the profitability of the trade. The other thing is attracting that retail audience and making sure that the spreads are tight enough. That's another factor. If you look at index options, I think you get a kind of a corollary here between the index options contract and the ETF contract. While they're different in terms of exercise ability and settlement, you do have that 1/10 size relationship. And IWM options are very popular. They trade upwards of 600,000 contracts a day, some days 700,000 contracts a day. You compare that to the RUT options, we do have days of 160,000 contracts, and we've averaged 88 month to date. Notionally, it's still bigger, but it's about a 60-40 split. So I think when there's a vibrant mini options market with tight markets, and that's probably the most important thing. Fees come in second. The retail user is more sensitive to fees.
Obviously, you're planning to launch a number of mini products coming down the road. Will you be working a lot with the exchanges and the brokers to make sure that these Russell minis don't perhaps fall into the same trap that some of the previous minis have, where it's kind of just kept the retail from really embracing them?
I think we will be talking with the exchanges and initially market making, the liquidity providing firms. We want to see nice tight markets. And looking at our volatility product, we're working with the exchanges and liquidity providers now to provide as tight a markets as possible. That can affect early volume. So that would be top of mind and going into it. And certainly to the extent that we can encourage them to have more competitive fees versus the big product, yes, that would be important.
That has been another strange development with these products. We sat around these tables 2 years ago at this conference, and all anyone could talk about was minis. It was going to be the panacea for all the ills of the retail options market. They're going to come back to the marketplace in droves. It was conceived as essentially a mini Apple product. The others followed, Google and the rest. And yet, we looked at it the other day, they're averaging about 11,000 contracts a day net across all the products. So when you divide that by 10, it's 1,100 contracts a day, not exactly lighting up the tape. And getting back to the markets, that really, I think, is the thing that surprised people the most. The fees, the other things, those can be worked down, but the markets in these products were atrociously wide from the beginning. They were orders of magnitude wider than anything you saw in the regularly sized contract. And that, of course, scared a lot of people away as well. They had to pay full freight to trade these things, and then to come into a marketplace where they're paying a huge amount of bid-ask spread to actually trade it. It just killed any value for the end user. So that'll be a focus of yours coming out to make sure the market-making community really embraces these products before you launch them.
Absolutely. That's very important. Liquidity is very important to launching new products. And, that's what we want to work on initially. Make sure that we have good, tight markets. Nothing will scare away users with markets that are wide, not very deep. Then match that with higher fees. That can have a very negative effect on a new product.
I heard a lot of different reasons bandied about for why the market-making community didn't really embrace the minis in any foreseeable way, shape, or form. I'd be curious what your take on that is. Why do you think the markets for these products initially and still to this day are so wide, and why there's been such a lack of liquidity in these? And what do you think you guys can do at Russell to really get the Russell product to overcome that hurdle?
Well, to be perfectly honest with you, I'm puzzled by it myself. You would think that, just divide it by 10 and
seems like a home run.
Yeah, but I don't know if it's processing capability, headaches, the cost of getting a hedge off, not just a straight lot hedge, things like that. I kind of scratch my head as well. And it is change. I mean, once a market gets active, gets developed, then all of a sudden there's a change or something slightly different. Don't ever underestimate change. If you go back to the VIX, the volatility contracts, when CBOE launched the VIX contract, that was change. Volatility was traded exclusively in the OTC market, or by buying strips of options in SPX, but volatility contracts themselves. And this was changed. And it was very interesting to watch the sell side and the liquidity providers adapting to a new lit market. So, I think maybe the change element is part of it as well.
Well, Pat, I'm glad we can get you back on the program. Obviously, a lot of things cooking from an options perspective over there at Russell. And before you go, anything else you want to leave our listeners with? Any hints, any teases for things coming down the pike?
Well, I would say take a look at the Russell 1000 listed options that we hope to launch here in the summer. Take another look at RVX, the volatility contract. I think there's some exciting things going on there. And, we'll be back on your show shortly, I hope.
Sounds good, Pat. I'm glad to see you here at the conference, and we'll have to do this again more often than once a year.
Yes, sounds good.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.